everyone. Welcome again to this edition of the MEST and Deloitte monthly webinars. As mentioned, I'll be your host for the day, Fiona Kuruja. Just to kickstart the webinar, for those who are new and haven't been with us before, MEST is a not-for-profit training program, internal seed fund, and network of hubs. We recruit 60 individuals across Africa every year and work with them to help them build software companies across through the one-year training program. With MEST Skill is a venture acceleration program designed by MEST in partnership with the MasterCard Foundation to help small and growing businesses strengthen their operations and address key technology gaps, as well as increase their ability and capacity to scale their growth. The monthly MEST and Deloitte webinars are aimed at discussing, the importance of business, financial, and risk advisory for founders and business leaders. In today's session, we're joined by Nania Cha and William Ohene, who are senior consultants at Deloitte Ghana. I'll let them introduce themselves, and in this session, we'll be delving deeper into corporate governance for small and medium businesses. Take it away, guys.
Thank you very much. Fortunately, my name is not appearing as it should be. I'm William Ohene. I am a manager in the risk advisory unit for Deloitte, and I have on the call. Please, is my screen visible?
No, it's not visible. Yes, we can now see your screen.
Great. So as I was saying, my name is William. I am a risk advisory manager at Deloitte. Risk advisory has a broad scope of services from enterprise risk management to corporate governance to cyber, IT, and specialized audit, financial risk, you name it. And I also have on the call Nanicha Otui Champon, who is a risk advisory consultant. So she'll be my co-facilitator for this presentation. So thank you for joining us once again. So at this juncture, permission to proceed.
Yes, please. Let's proceed.
Okay, thank you very much. So thank you all for joining us on this call. So the objectives of this and outcomes of this webinar is to, first of all, help you appreciate the definition of corporate governance. Then we'll look at corporate governance, the corporate governance requirements from a legal framework point of view. Then we'll look at the key elements of effective corporate governance, move on to the role of key stakeholders in corporate governance. Then finally, we'll be looking at some case studies of failed corporate governance. Okay, so I don't know if everyone has access to the chats, but if possible, can you confirm what your understanding of corporate governance is? Maybe you could select 1, 2, 3, or 4 or 5. So in the chat box, I would actually want, the participants, if possible, just let me know your understanding of corporate governance. You can just type in the 1 to 5 option, just to let me know the level of understanding of corporate governance from the participants. Do the participants have access to the chat?
Yes, they do. They can send in their responses on the Q&A chat box at the bottom of their screens. So they can send in terms of like Q&A.
Okay, I can see 3, 4, a lot of 4s. I think majority are going for 4. Okay, I think we have enough at this point. So I would say you are neither right nor wrong because it's a mixture of a lot of things depending on the perspective that you are looking at. So when it comes to corporate governance, a layman definition is basically the system by which companies are directed and controlled. Direction being making of decisions and controlling being giving guidance as to what is expected. So corporate governance involves balancing the interests of many stakeholders of the company, such as the shareholders, your employees, your management, both senior management and junior management, your customers, your suppliers, your financiers, from be it the banks or whether it's a venture capital or whatnot, and also the community in which you operate. Now, getting governance right is quite an essential aspect when you want to build public trust in companies. So these are a few definitions of corporate governance. Mind you, in terms of corporate governance, there are so many bodies and how they define corporate governance, but there's one thing or two things per se that resonate in almost all of them. It's all a matter of direction and controlling. So for BOG, that's the Bank of Ghana, which is the central bank in Ghana, their definition is the way the business and affairs of a regulated financial institution is governed by its board and senior management, including how its strategy and objectives are set, its risk appetite, tolerance are determined, its day-to-day business is operated, as well as the interests of depositors being protected, and also shareholders' obligations being met. Now, this definition helps most financial institutions more or less put in place the structures required for good corporate governance. And just to put things into context, in Ghana, the most highly regulated industry is the financial services industry. That is the banking sector. We also have the NIC as well as the SEC. However, this is the BOG definition is much more, relevant because of how highly regulated it is. So there are other definitions as well. And one thing which, one of the definitions, which is very, very succinct and spells out what is required for corporate governance, is the one from the ICSA, that's the Institute of Certified Secretariat. And that is basically saying that corporate governance is the system of rules, practices, and processes by which a company is directed and controlled. And this is very, very fundamental and very, very important if you want to operate well and actually succeed in meeting your objectives. So just to walk you through a quick evolution of corporate governance. Corporate governance has always, to some extent, in principle, have been in existence. However, in 1992, due to some issues related to the Cadbury incidents, the committee was set up to develop best practice for corporate governance for the London Stock Exchange, as well as the FRC and the Account for Professions, which was set. So basically, in 1992, there were a lot of, preceding, or should I say, corporate governance failures happening in most of the entities in the London Stock Exchange. So a committee was set up to more or less formalize and codify what is expected from a corporate governance point of view. And trickling down into the years ahead, there was a major collapse in one of the biggest companies in America. That's in 2007, that was Enron. And this failure was also due, this collapse per se was also due to failure in corporate governance. That is, the direction and controllership of the business was not actually being done as required. Hence, a lot of lapses were not noted or identified, and which could have actually been prevented in the collapse of Enron. In 2008 as well, there was a financial crisis, and this led to the Lehman Brothers Bank collapse. Now, moving it from a global point of view to the Ghanaian perspective, the first proactive corporate governance framework was set up by the NIC, that's the National Insurance Commission, where they came up with a governance and risk management framework for its licensed insurers. So this more or less gave them a code or a guideline as to how insurance companies or insurers are to put together a corporate governance framework, as well as a risk management framework, which spells out the base basic requirements for an entity to succeed in terms of, presenting good corporate governance. And this was, however, not exhaustive and very comprehensive. I think based on certain dialogues in the industry, there's an expectation for it to be updated just so it meets the current industry requirements. So in 2017 as well, as you all know, the UT Bank and Capital Bank takeover by GCB and other issues related to the collapse of many banks in Ghana. And this led to the BOG, that's the Bank of Ghana, which is the central bank in Ghana, coming up with a corporate governance directive to spell out the rules and requirements for each bank, that is each financial service institution which is regulated by BOG, to more or less follow to ensure that good corporate governance is upheld. So based on the 2017 incidents, in 2019, there was a cleanup exercise by Bank of Ghana, which led to conversations around the National Code of Corporate Governance. And in 2019, a new Companies Act was passed by Parliament to more or less give an update to the existing Companies Act, which had been established years back. And in 2022, the National Corporate Governance Code was brought into existence, which more or less gives a lot of guidance as to what is expected for good corporate governance from a Ghanaian point of view. And bear in mind that all these things more or less aligned with leading practices globally. So at this juncture, Nanicha, I'll hand over to you to look at the legal requirements in terms of good corporate governance.
Okay, thank you very much, William. As he mentioned, I'll comments from the legal perspective of corporate governance in Ghana. And as I go through, I'd ask that if there are any questions, you drop it in the Q&A box so that we can answer it along the way. Okay, so in Ghana, companies are governed by the Companies Act. The new Companies Act we have now came into being in 2019. It took over from the previous Companies Act, which was Act 179. And this new Companies Act, it replicates a lot of things that were in the old Act. However, there are a few changes in the new Act, such as the registration of a constitution of a company. And so in the new Companies Act, it's not required that companies register a constitution, because once an institution is incorporated, it becomes a legal person. And so just as human beings who are natural persons in law, we can enter into contracts. Companies are also allowed to do that and enter into whatever business they want, so far as it is legal. And so there's no requirement now for companies to register a constitution. However, they are still not barred from doing that. In a company, the Act, even though we say that companies can enter into contracts, we know that companies work through people, and the main or principal organs through which the companies work are either members in a general meeting or the board of directors. And so if you look at the Companies Act, it gives certain powers to these principal organs and states the things that they can do and the things that they cannot do. However, companies are also entitled to include in their internal constitution any further powers that they want either the members to have or that they want the board to have. William, please can we go to the next slide? Okay, so we'll proceed now to look at qualifications and appointments of directors. And if we say directors here, we mean directors who make up the board of a company. So directors properly so called under the Companies Act of Ghana. Some of the things that is required, so usually when it comes to the qualifications or persons who are qualified to be directors, you won't really find a list of people who are qualified. You rather find a list of people who are not qualified to be directors. And so you can't have someone who is an infant that is less than 18 years. You can't have someone who is of unsound mind. You cannot have somebody who is an undeclared bankrupt. So you look at the things that the Companies Act uses to disqualify members, people who cannot be directors. And then if you go through that list, you take off certain people, you'll be able to know, okay, then these people are qualified to be directors. Now, under the new Companies Act, it says that directors should confirm in writing that they have consented to be appointed as directors. So now when an appointment is done by the board, because it's by the shareholders, because it's the shareholders who appoint the directors to work for the company. So when a person is appointed as a director and you have gone through all the processes and you are qualified, you've been given the nod, the director has to consent in writing that they agree to take up that position. So some of the things that disqualify people or that makes them not qualified to be directors are people who have been convicted of offenses such as fraud or dishonesty, who have been convicted of an offense relating to the promotion or incorporation or management of a company, and people who have also been convicted for a company being insolvent. So if you have any persons who within the preceding 5 years have been convicted of any of these offenses, they do not qualify to be a director of a company. Furthermore, there are certain restrictions or limitation periods for certain convictions. And so if a person is convicted of, like what we mentioned, dishonesty, fraud, a company going insolvent whilst you were in a directorship or executive position, or you've been disqualified from holding a position as a company secretary, a receiver, or a manager. Because these kind of offenses, you are barred from being a director of a company for 5 years. That is on your first conviction. If there is a second conviction, you are barred for 10 years. And if there's a third conviction, then such persons will not be qualified to be directors at all. Please, if we could move on to the next slide. Okay. So it's important to note that currently under Ghana's laws, directors have liabilities, both civil liabilities and criminal liabilities. And these are personal liabilities to the director. So when selecting people, assuming you have a company, you choose people to be on the board, or you are even a director of another company, it's important to note that there are personal liabilities that directors bear. So you don't just go around picking or accepting appointments to be a director. Of course, if it is found out that you were personally liable, there would be a punishment attached to that. So let's just keep that in mind. So as directors of a company, there are certain interests that the directors have to have to the company. And the director has to avoid conflicts of interest. So the director shouldn't put himself or herself in the position. Hello, please, am I audible?
Yes, you are audible.
Yes, you're audible. Yeah.
Thank you. So first and foremost, the director has the duty not to hold himself or be in a position where there's a conflict of interest. So the director shouldn't put himself in a position that his duties as a director to the company conflicts with his personal interest or his interest to other persons. Because as a director, it's important that you work in the interest of the company, not in the interest of the shareholder, because sometimes the interest of the shareholders may not always align with the interest of the company. However, your duty is to work in the interest of the company. And so it won't really be prudent to be in a position where your personal interest or your interest towards somebody else will conflict with the interest of that you hold to the company. Directors are also prohibited from being present or voting in respect of contracts at a meeting where the director has a material interest. So in the Companies Act, it states that directors can enter into contracts with the company that they serve for. However, there must be disclosure. And so if during a board meeting, there are certain items on the agenda and the director knows that he has an interest in it, the director must disclose that interest fully to the board and also recuse himself from that meeting so that the remaining directors can be able to discuss it without that director being present. And also that director must not be present whilst voting is going on, because obviously you know that the director would more likely than not vote for himself if he has an interest in whatever contract is being discussed. So yes, so contracts in which directors have interest must be disclosed to the board, and they must also recuse themselves from that meeting and from voting. Okay. And just to mention, companies must have conflicts of interest register. This is kept by the secretary of the company, so that if any director discloses an interest, it will be noted in the conflicts of interest register. And it's also important to know that usually at the beginning of every meeting, the secretary present should ask if the directors have any interest to disclose. And then whatever interest is disclosed is included in or noted in the conflicts of interest register. Okay. So for these kind of liabilities, any director who defaults and is found liable would be liable to pay a penalty between 250 and 500 penalty units. Currently in Ghana, one penalty unit is 12 cedis. So depending on the offense and depending on what the registrar decides that the director is liable to pay, if it is 250, if it's 300, if it's 400, you multiply that by 12 cedis, and then the director knows how much they have to pay. Okay, so these are some of the civil liabilities for breach of duties of the directors, as we mentioned above or in the previous slide. So firstly, a director or anyone who participated in the breach is liable to compensate the company for a loss that the company had to bear. Then the director would also account to the company for any profit that was made due to that breach of duty. And then any contract that was entered into between the director and the company during that breach may be rescinded upon. So these are some of the, these are some of the actions that the company can take when there's a breach. And this is, as I said, when there's a breach because the director did not disclose. If everything is done transparently and there's full disclosure, then these things would not apply. However, where there's no full disclosure and later on the company finds out that there has been such a breach, then the company may rescind and may ask the director to pay for a loss and account for any profits made. Please, is there any question at this point, or I can continue to the company secretary?
No question at this point.
Okay, I think
there's one question which I think you've already captured. What are some of the practical examples of the interest that a director may have in the company, I presume?
I have a question as well. One that is answered. You mentioned insolvency as one of the things that make you liable to not be a director in the company after 5 years.
Sorry, I can't.
Hello?
Yes.
Hello? So insolvency, is that if a company is unable to pay its debts and becomes insolvent, is that basically treated as a crime for the directors?
Okay, so it depends on the cause of the insolvency. So not just because the company is insolvent, then it's a crime. So insolvency is basically where the company is not able to pay their liabilities as and when it falls due. And so when an investigation is undertaken and it's found out that the directors intentionally acted not within the interest of the company, but to their own benefits, and that led to the company being insolvent and having to be liquidated or wound up, then there may be some criminal or civil actions against the director, but not necessarily because the company just went insolvent, and so someone has to go to jail for that. Yes, I hope I answered your question.
100%. Thank you. Thank you.
I think there is another question. Well, these are part of the earlier act, or these are new amendment to it?
Well, what exactly?
So the examples you gave and the sections that you quoted, I think the person wants to find out if they were all part of the earlier act, or these are amendments to the new Companies Act.
No, so some of these, some of them were already existent in Act 179, and some have also been improved upon, obviously, as things change and current trends, both on the global scene and within the country, it leads to certain amendments. But so this new act, that Act 992, is not an amendment to the old act, because the old act was completely repealed. So this is a new act. So it's not an amendment to the old act, yes, but some provisions were maintained, some provisions are new provisions that have been included in this.
Okay, and I think the last one is a director equal to a startup or a founder. I think I'll take this one. I think with regards to, I've heard a lot of, I've had a lot of debates on this distinction. And basically, if you are looking at definitions, a shareholder is someone who is investing capital into a business, and a director is someone who has been given the stewardship to direct and control a business. So there is a difference between the two. However, when it comes to smaller organizations, in most instances, you realize that the company's shareholder, that is the person funding the operations of the organization in terms of giving capital, is the same as the director. And there is not, it's not necessary, I wouldn't say that is wrong, because of the size of the company. However, once the company begins to grow, there should be that level of distinction between directorship and ownership, that shareholding, just so that the level of corporate governance required, good corporate governance that is required, can be properly upheld. Because bear in mind that if you're a shareholder and at the same time making decisions for the business, then at the end of the day, there's no level of objectivity in terms of what is good for the company. I don't know if that makes sense. Nani-chan, you can add on if you want to.
Okay, thank you, William. So yes, as William said, there can be that distinction between a founder and a director. If you look at the Companies Act, Act 992, it defines a director as any person by whatever name called, who is appointed to direct and administer the business of the company. And again, as I said at the beginning, in the context of the Companies Act, when they mention director, they mean the board of directors, not necessarily anyone who just has a title of director of this, director of that, director of that, but actually the board of directors. And in some situations, you can have the founder or a majority shareholder or someone who may sit on the board. But technically, if you want the company to really be run well, then you as a shareholder should be part of the shareholders. And then you should also have your directors who are distinct and who would work in the interest of the company, who would have that independent mind to run the business for the interest of the company, and not necessarily just to the what's the word, like what the directors, no, what the shareholders want, because they are the ones who just put in money. So we can't make that distinction between the founder and the board of directors. Okay, so please, I'll continue now with the company secretary. The company secretary, the Companies Act makes provision for a company secretary who can also be the board secretary in the case of companies that have boards. Now, there are certain qualifications of people who can be company secretaries. So you can have a person being a company secretary, and you can also have a corporate body being a company secretary. However, there's that requirements that if you choose a corporate body to be your company secretary, then there should be someone within that corporate body who qualifies to be a company secretary. So you can't just nominate a board, a company or a body corporate to be your company secretary, and there's absolutely no one there who qualifies. That would be going against the law. So let's look at some of the people who qualify to be company secretaries. So you can have a person who has a professional qualification or a tertiary level qualification that enables that person to have the requisite knowledge and experience to perform that function. You can also have someone who has trained under a company secretary for at least 3 years. You can have someone who is a member who is in good standing, either with Institute of Chartered Secretaries and Administrators, the Institute of Chartered Accountants, Ghana, or a lawyer in Ghana. So any of these people are qualified to be company secretaries. The company secretary is appointed by the board of directors and is also removed by the board of directors. So it's a contract that the company enters into with the company secretary. You find someone who qualifies within the requirements under the Companies Act, and then you choose them to be your company secretary. They know their job description, you agree on their remuneration, and yes, and then if there are any issues you want to remove them, it's also the board of directors who has the power to remove the company secretary. And it's important to know that you can choose, so a company can choose a director to be a company secretary if the person qualifies to be a company secretary. However, in the Act, if there's anything, any job, any duty or responsibility that you need a director and a company secretary to do, you can't have one person doing both. So you can't have one person saying, okay, because I am a member of the board of directors and because I'm also the company secretary, if we are filling a form and the form needs 2 signatories, one director and one secretary, then I will fill both for both positions. It doesn't work that way. So to choose, it doesn't state it explicitly. However, the company should have enough company board of directors so that even if there's one person who doubles as both a director and then a company secretary, there won't be that lack or there won't be that gap when this requirement arises that the company secretary and a director of the board has to sign a document or do something, and then you need 2 distinct people to do it. Okay. Please, let's move on to the next slide. Auditors. It's also important, one of the key things about corporate governance is that companies must have auditors. And in this situation, we are talking about external auditors, not the internal auditor. The Companies Act provides for who qualifies to be an auditor of the company. And basically, it's someone who is qualified and licensed in accordance with the Chartered Accountants Acts 1963, Act 170. And so the person that the company would choose to be an auditor should be someone who is qualified under the Act. That same person should also not be disqualified in terms that they are a partner or in the employment of the same company. They are an infant, they have been adjudged to be of unsound mind, or an undischarged bankrupt. Now, looking at the first 2 points, which is an officer of the company or of an associated company, or a partner or in the employment of the company or an associated company, is because, as I mentioned at the beginning, this section about auditors refers to an external auditor. So you can't have an external auditor who is also in your employment. Your internal auditor, yes, but then for the external auditor, you need that person with that independent mind who would come in and do the job properly and see whether what the internal auditors are saying is true and they are corroborating it or picking out any issues. And so that's the need for this distinction in the Companies Act. Next slide, please. Okay, so we've just talked about some of the corporate governance requirements under the Companies Act. This is for the Payment Systems and Services Act 2019, Act 987. Before I continue with this, if there's any questions under the Companies Act, before I proceed with Act 987.
I think you can proceed. If there are any questions, kindly drop them in the Q&A section. We'll gladly respond.
Okay. So the Payment Systems Act and Payment Systems and Services Act came into force in 2019. And though it covers a broad range of things, we'll just, again, focus on corporate governance under this specific act. So, and that is covered under Section 18, which is titled Governance Arrangements. And so a payment systems provider shall have a board of directors with a minimum of 3 members, at least 2 of whom shall be residents in Ghana, including the CEO. So for PSPs, it is a requirement that they should have a board of directors. Now, the members of the board should also be fit and proper persons with the requisite experience and qualifications to perform their functions as board members. If you look at the Bank of Ghana, because they regulate the PSPs, they also have a directive for fit and proper persons, which states that people who qualify to be board of directors must have the requisite knowledge, requisite skills, experience. They should even have the time. They should have a good reputation. So all these things have to be taken into consideration to ensure that the people that PSPs appoint to be members of the board fit this fit and proper requirements of the Bank of Ghana. The board would also be responsible for strategic decisions, oversight, risk management, compliance, and internal controls. Basically, the board of directors, they have overall responsibility or oversight for the company. And so determining the strategy that they will take, determining everything about controlling and directing the company falls with the board of directors. The key management personnel shall be responsible for maintaining effective system of operations with regard to payment systems. So as mentioned previously, in a company, depending on the size of the company, you would have the shareholders, you would have the board of directors, and you would have executive management or executive directors or key personnel who the board puts in place to run the day-to-day affairs of the company. And so for the PSP, this key management personnel, or the people at the top, are the ones who ensure that there's an effective system of operations for the payment systems. And then these people report to the board, because that is the chain of command. The key management or the executive directors, they report to the board. And then the board also, during shareholders meeting, AGMs, they also give a report to the shareholders. Now, finally, the Bank of Ghana, as the regulator for the PSPs, requires that they have a chart showing the line of control of responsibilities, decision-making. So basically, there should be that organogram, there should be the line of chain of responsibilities and commands, and how the PSPs function, who reports to who is responsible for what. All that organizational chart should be made available to the Bank of Ghana, because they require that their regulated institutions actually follow proper corporate governance directives or systems or framework within the company. Okay, so we'll quickly look at Bank of Ghana's Corporate Governance Directive 2018. This is to all their regulated institutions. Okay, so just a brief overview of some of the main things in the Corporate Governance Directive. The board is the one that has overall responsibility for the company. So they are setting the strategic objectives. They are setting risk strategy. The board is setting corporate governance framework. The board is setting, corporate values, code of ethics, or everything about the company and how it is run. It is the board that has that responsibility. Secondly, there must also be disclosure of interest, as I mentioned before. If there's a board member, there's any issue that comes up, any item on the agenda, you have to be able to disclose your interest fully to the company. Now, every year, within the first 90 days, the board also has to provide a certification to Bank of Ghana saying how they are able to comply with this corporate governance directive issued by the bank. So in every annual report, there is a section in the annual report that the board has to certify or state that, okay, we are following this directive by Bank of Ghana. We've been able to follow it to this level, and we are still maybe putting in efforts to ensure that we are fully compliant. Another topic in the Corporate Governance Directive is the related party transactions. So the Bank of Ghana is aware that sometimes the contracts that the companies enter into, it may have to do with related persons. So either someone's relation, a subsidiary, a parent company, an affiliated company, all of these things can happen. And so when a company is entering into such a transaction, there must be a policy which guides how that transaction goes through, so that the transaction will still be at an arm's length and there won't be any cutting of corners or giving contracts just because that is a related party. So the company must have this policy in place. Please go to the next slide. Okay, so plan for succession. Companies regulated by the Bank of Ghana are expected to have a plan for succession. This is to cover for both planned exits and even unplanned exits. Covers also both the board and then the key management or executive directors. So that there won't be any gap which would rock the company, or the company will now have to scramble as to what are we going to do. This key person has dropped out and we didn't plan for it. So it's very important for companies to have a plan for succession. As I mentioned, the board qualifications of the members, they have to be qualified and they also have to get regular training even as they're on the board. For board meetings, expected that companies would have at least one meeting every quarter, so which would be 4 meetings in a year. And board members should receive the meeting packs or agenda maybe about a week or 2 to the board meeting, so they can be able to go through. And then when they come for board meetings, there will be constructive input during board meetings. Board performance evaluation. The Bank of Ghana requires that its institutions that they regulate have board evaluations every year. So once a year, the company itself must have an internal board evaluation, and then once every 2 years, they would have one being done by an external person or consultant to ensure just to check how the board is functioning as a collective board, as individual board members, there are subcommittees, to ensure that everything is running properly and the board is actually running as it should, as efficiently and effectively as it should. So board subcommittees, depending on the size of the company, a company can have several board committees, but the required ones for Bank of Ghana or institutions that are regulated by the Bank of Ghana are the Audit Committee and the Risk Committee. These 2 committees is non-negotiable. A company has to have an Audit Committee and a Risk Committee. You can have other subcommittees like HR, governance, and others. But then these 2, audits and risk, it is a requirement for every single company to have one. There must also be a conflict of interest policy. similar to what I mentioned above, if there's any conflicts of interest, there should be a policy which would regulate how it will be handled. Risk management and internal controls. The company would have a risk committee, which is one of the required subcommittees. It would also have an internal risk function. It would have a risk officer. All these people ensure that, as I said, the company runs properly. Internal controls are in place. There's risks to know when something is about to go off, to be able to preempt certain risks, and manage the effects that they would have. Ethics and professionalism. It's the board's responsibility to ensure that the company has code of ethics policy, which governs or regulates the said institution. And this code of ethics has to be signed by all persons, whether the board members or the employees, because you have to lead from the top. The board cannot have code of ethics conduct, and it applies only to those at the bottom, and then those at the top are doing whatever they want. There should be a code of conduct which governs how the company is run, what values the company cherishes and would like to have and kept in the company. I think we've done these. Okay, so questions. If there are any questions, I think I'll take them now before I go to the National Governance Code. Okay,
so there's a question. Do the requirements and directives also apply to companies with board of advisors?
Is this specifically related to companies which have the Bank of Ghana as their regulator? Because if it's in relation to the slides I just spoke about, those are for companies who have the Bank of Ghana as their regulator.
Okay, and just to add on, the reason why we more or less focused on BOG requirement is basically that due to the fact that BOG or Bank of Ghana is the highest form of regulation in terms of the industries that we find in Ghana. So, for example, go to the telcos or the oil and gas industry, there are said regulators haven't really come out with clear and adequate directives or guidelines or acts which would more or less support these organizations in the said industry. So we more or less, we focus on Bank of Ghana, which has all these things, just so, to ensure that if you would want to have systems in place which are consistent with leading practices, Bank of Ghana can be your benchmark, just so, you can look at, from a maturity point of view, try as much as possible to get these things in place to have the highest level of compliance. So that is it for the Board of Advisors. And just to add on, when it comes to Board of Advisors, bear in mind that they to some extent are not they are not stewards of the company. They give advice to the company as to how to make strategic decisions. However, the Board of Directors have a fiduciary duty, and they are supposed to ensure that the company is controlled and directed in the most appropriate manner, and also ensure that operations are running smoothly and profitably. So this is just to give context between the Board of Advisors and the Board of Directors and how it may apply. Okay, so I think we've answered this one. The next question is, please, in what ways does the Companies Act affect companies which are incorporated outside of Ghana but operate within Ghana? Nanichan, would you want to take that, or should I go ahead?
If you look at the Companies Act, there are provisions for companies like Ghanaian companies, and there are also provisions for companies that are foreign companies. And then if you're also a foreign company, depending on the sector you fall in, you may also have to look at maybe the GIPC Act, depending on which company that you that you are. So yes, the Companies Act also has provisions covering foreign companies that operate within Ghana. William, if there's anything you want to add?
I think that's fine. We can go ahead.
Okay, so recently, which was just a few months ago, in November 2022, Ghana had the National Corporate Governance Code, which was quite an important code to have, because usually the codes that exist are very sectoral. So you would have corporate governance codes for the banking sector or for the companies listed on the stock exchange. But then this code tries to incorporate several codes or codes that relate to several industries, and even includes others like the informal sector, NGOs, small and medium scale enterprises. So now with this code in existence and with a provision for small and medium scale enterprises, we can have a bit of context in terms of corporate governance for these SMEs. So we'll look at corporate governance specifically for SMEs as provided for in the National Corporate Governance Code. Okay, so if you look at the code, it talks about some of the importance of corporate governance to SMEs, and I'll just quickly go through them. So one of the importance is that it safeguards the millions of jobs that they provide to local people. It contributes to the enhanced revenue mobilization for government, and also puts the SMEs firmly on a path for sustainable growth. Because as you know, the point is that these SMEs do not just become the usual. You set it up and it's just for the founder, and after a few years, it just goes down, but then there is sustainable growth. Another importance is that it brings many benefits to the owners or operators of the SMEs, including promoting positive management and employee behavior. It improves decision-making processes. It improves internal controls and business efficiency, and it potentially lowers cost of capital. And then most importantly, it promotes business accountability and transparency, thus unlocking capital needed for growth, including from international investors, venture capitalists, and commercial lenders. So even with this, the Corporate Governance Code, it takes into consideration that the importance of corporate governance even to SMEs and for their future growth and expansion in terms of getting investors to invest in the business. Okay, so if you look at the governance section, there are four main things that it covers. We'll quickly go through them. One is leadership. So it's important that SMEs have a clear governance framework, including governance structures, to ensure that there's accountability and then there's transparency. And if you look at the code, there's a distinction, or it tries to make provision for startups, for small scale enterprises, and also for medium scale enterprises, because it knows that not all the companies are at a level of having boards of directors. And so for any of these things, if there's a company that is more on the smaller scale or a startup, you can have an advisor or someone who gives counsel in relation to corporate governance. So if the code expects you to do something, it's not just like, oh, because I'm a small company and I do not have a board, and then it doesn't apply to me, because hopefully the owners are thinking of longevity for their businesses. And so you can have an advisor who would advise on these things, or if it's a company that has grown to the point of having a board, you have the board being responsible for certain things. So the SME is supposed to have a corporate governance framework. If they are directors, they are the ones who are supposed to ensure that there's effective decision-making, there's conflicts of interest policy, related party policy, and all the things required. You realize that some of these things cut through. So even some of the things we mentioned for maybe PSPs or for the board, it's also mentioned here in SMEs. with in relation to, let's say, these policies. The SME should also ensure that there's a clear succession plan, just as the Bank of Ghana Corporate Governance Directive also mentioned. And some things I think not here, but then it's also within the code, is that you have to have clear division of responsibilities, so that if you have a board and you have key management, you know, okay, what are the responsibilities of the board? What's the responsibility of key management? There's transparency. You keep proper records. If there are meetings, there should be minutes that are taken, irrespective of whether you're a big company or you're a small enterprise. You should have proper minutes that are kept, proper records that are kept in the company. There should be, the leadership of the SME should ensure that they set a tone where it discourages dishonesty, and it rather encourages honesty and hard work. These are all things that the leadership should do to encourage the employees in the company, to even encourage those at the top, to ensure that they are working for the interests of the SMEs. Now, controls. It's also the SME should ensure that they follow credible accounting practices from day one. So not when they become big companies and they now have boards, but right from day one, you should follow credible accounting practices. Utilize a reputable independent accounting firm, and they will be responsible for ensuring that your financial statements, everything has to do with your finances, taxes, everything is properly taken care of, irrespective of how small the SME is. SME should also establish a formal process for identifying business risks, adopting formal control mechanisms. The owners of the SME should separate business accounts from that of the owners. This is to ensure that you are running the business properly. If you're expecting to get investors and they come to look at your books, they would see that things are being run properly. And then the owner does not run the SME like his personal sole proprietorship and mixing up accounts, taking money from accounts as and when he pleases. There should be a transparent policy for reporting misconduct and unethical behavior. Code of ethics, as I mentioned, it should apply to both the staff and the management board of directors. And then where the SME is family owned, it is important to define a formal approach to the family's relationship with the business. So do you want it to be only family owned? How many family members do you want inside? Do you have to train them? What's the percentage of family members and outsiders you want? Even if it's a family business, there should be proper structures on how the company or the SME is run. Okay. Another topic covered under the governance code for SMEs is disclosures. Again, SMEs should ensure that they prepare their financial reports according to national and internationally recognized standards at least once a year. All material and non-financial information is adequately disclosed to all shareholders. I'm sure if the SMEs put in place measures to have qualified accountants and auditors, they would be responsible for doing all of these and ensure that their books are properly kept. The SME should also establish timely, open, and transparent channels of communication with their stakeholders. Equal access to information, disseminate information through various channels such as your company's website, newsletters, annual reports for ease of access to their stakeholders. And even the clients of the SMEs and the customers are also stakeholders. So if they go on the websites, the company websites, they should have some information. It brings some sort of credibility to the company, knowing that people can easily access the company's information and it is not a scam or just there to dupe people, but it's actually a proper existing company. And then humane engagements. SME should participate to sign up for skills development initiatives. It has listed a few of them, which I'm sure can be, people can get access to, whether within Ghana or outside Ghana. There are also SME owners and operators should also recognize and respect the rights of capital providers, your workers, very, very important. They should be treated well. SME should also consider the effects that their business has on the environment. In this day and age where there's a lot of talk about ESG, and having investors actually asking companies about ESG matters before investing in those companies is important to also keep track of it. If there's something that you are doing, you can document it and say that, okay, maybe in our business, we don't waste electricity, paper, include it, and it should be well documented for future reference, and especially if you are trying to get investors in the business. It's also good to, the SME should also encourage and advise organizations in the supply chain to adopt environmentally friendly approaches and comply with national laws on human rights and child labor, and not engage in unfair labor practices. So it's not all about just the money, and the profits, but even how you treat your employees. It's all covered under corporate governance and under the laws. Okay, so I think this would be all for the national corporate governance codes, and then the other few laws we have looked at in the past few minutes. If there are any questions, I'll take them now before I hand over to William to continue.
Okay, thank you very much, Nanisha. So audience, the Q&A session is open to all. So if you have any questions, feel free to drop them in. I would answer them accordingly. So Nanisha has really taken us to the baseline requirement in terms of looking at corporate governance from the legislation or from the legal aspect, and in terms of also the regulatory bodies and what they have put in place to ensure that sound and good corporate governance is established in companies, from a big company to even a small or medium scale enterprise. So delving, now that we have done the legal aspect, let's look at the core aspect in terms of the spirit of things. What's the elements that you need to have in place for your corporate governance agenda to be effective? So when it comes to an effective corporate governance, there are some concepts that should be in place. The first thing is about integrity. Integrity shows how trustworthy you are, how truthful you are in your business, and when you have upheld to have high level of integrity, people trust what you say or do. So it makes your business very credible. There should be some level of transparency as well. Enough disclosures to show that you are doing what is required, and you are even giving enough information for decision makers outside and within the company to make informed decisions, just so that they can make decisions in the interest of the company, and also which aligns with their values, objectives, and their agenda. There should be some level of fairness, or there should be a high level of fairness in the business. Things have to be done with equity and equality, to the extent that there is no level of, for lack of a better word, or to put it in layman's term, there's no cheating in the business. Things are done in an open manner, just so that your outside stakeholders, your external stakeholders, can have that level of trust in the business. There should be accountability as well. Things which have been set out by the organization, which is driven by the tone from the top, that is from the board level, that is equal to the corporate governance aspect that we are talking about, should have some level of accountability in their actions and in the results that are, or outputs that are obtained. So for example, when there is a decision to be made, the decision makers of the organization should have that accountability, cap on, just so that once they are making decisions, they know that they are accountable for their decisions. So they would be doing that, making the decisions in the right manner, which will ensure that the business is, operating as expected. There should be some high level of independence as well. when there's independence, there's no bias, and your judgments are not clouded to some extent, so that you can make the right decisions for the company. And Nanicha mentioned earlier, when it comes to disclosures of corporate conflict of interest, this is a requirement just so that sound decisions can be made in favor of the business and not of the those put in power or those who are being put in place as stewards of the business. There should be high level of responsibility as well. Directors should act and to be seen to be acting as responsible. The decisions that they make, they should have the highest level of responsibility in it. In terms, it could be from an environmental factor to a social factor to even the governance factor that we are speaking of. That is an acronym for ESG anyways, just so that the level of accountability and responsibility that is required by those in the directorship and controllership of the business is well put in place for the business to thrive and operate as effectively as possible. And the last bit is honesty, which sometimes, to some extent, some people more or less align honesty with integrity, because once again, if you are not honest, people will not hold you as a trustworthy person, and the level of integrity that you may have may be found wanting, and that would ultimately affect how your stakeholders relate to you. So in a nutshell, these are some concepts that you need to have in place or have to or more or less have in mind, just so that when you are making decisions or setting policies, you do it in the most prudent manner and in the interest of all stakeholders. That you've in the interest of all stakeholders and also in the environment you find yourself in. So, looking at the importance of effective corporate governance. So, first of all, when there is effective corporate governance, there's increased transparency and stakeholder trust. I think I've hammered and I've reiterated. I want to reiterate it on this slide as well. I mentioned it in the earlier slide. When there's a high level of transparency, it increases your stakeholder trust, and they would want to do business with you, both internally and externally. It also helps in commendable reputation and recognition. Once you are trustworthy, you get a good reputation and you are known for the good deeds or the uprightness of your business, which gives some level of good reputation and recognition. Also helps to reduce regulatory sanctions. Once you have effective corporate governance in place, all regulatory aspects of the business are well well noted and covered in terms of who is accountable for what, and the board of directors have in place people or have given direction to people to be responsible for the ensuring that the regulatory aspect of your business have been taken care of. Now you look at the aspect of conflict and scandals. If you have an effective corporate governance or sound corporate governance put in place, the level of conflict and scandals are reduced because there's a high level of transparency and people are accountable and are working responsibly. So these outcomes are decreased. And lastly, it improves the organization efficiency. Once the tone at the top has been clearly set, directors have made sure that they've put in place the right policies and procedures that will help run the business on a day-to-day or an operational in an operational manner. There will be some level of efficiency and improvement in the operations of the business. So that is it for the importance of effective corporate governance. In terms of boards, there are some characteristics of the board which shows that the board is dysfunctional. And the dysfunctional board is the board which basically, in a layman's term, isn't functioning as expected. There are gaps in it. You can tell that the board of directors are not aligned internally as a collective, as well as ensuring that there's some level of goal congruence with regards to the business. So first of all, the first thing you can notice in terms of a dysfunctional board is that board members are unclear about their responsibilities. As I mentioned earlier, in terms of the key concept of corporate governance, there should be some level of responsibility. You should have board members in place knowing the purpose that were brought into the business. So, for example, when it comes to a board, there should be some level of diversity and inclusion. Diversity being the board should have all-round level of expertise in terms of what is required to make the business run from an executive point of view to a non-executive point of view, so that decision-making can be very constructive and the right questions are asked. So in terms of responsibility, once your responsibilities have been clearly defined, you know your role in the business or your role on the board and what is required from you. The next one is looking at board members do not take their role seriously. So if you are a board member, bear in mind that you are more or less in the highest role of the business in terms of how the business is supposed to operate. You make decisions on behalf of the business. Hence, the business will thrive based on the decisions you make. And if they are sound decisions, then obviously there would be beneficial results at the end of the day. Now, if you're a board member and you don't uphold the responsibility being given to you as a board member in the highest esteem, you may not be acting in the interest of the business, and this will consequently, lead to the demise of the business. The next one is board meetings are enjoyable, but decisions are rarely made. Board meetings are supposed to be held to ensure that the right decisions are made to steer the company in the direction that it's supposed to be in. Now, if there is a board whereby it's very interesting or enjoyable to the extent that, people are talking about social fun stuff, which are interesting and engaging, but not focusing on what is expected from a decision-making point of view of the business, you realize that the business wouldn't be functioning, or the right decisions wouldn't be made for the business. Hence, the business wouldn't be operating and meeting its objectives. Now, the next one is decisions are made, but they aren't followed through or implemented. As a board as a board, you are supposed to make decisions for the business. And in making the decisions, you have to ensure that you have the right management in place from a tactical level down to the operational level to implement the decisions, the strategic decisions that have been made. Now, if you are only making, strategic decisions but are not implemented, that means there's a break in the dissemination of information, and that ultimately leads to the fact that the board is not really having a good or an appropriate, or should I say, adequate dialogue between senior management and their expectations, as well as setting the right KPIs for the organization or key management personnel to ensure that what has been decided upon during the board meetings are actually fully implemented. Now, the fifth one is board members do not get along, and there's conflicts. Conflicts are common in the board. So at this point, when you realize that there's always some level of disagreement in the board or during board meetings, it means the board members are not aligned in terms of interest ultimately for the business, because if the business is supposed to thrive, it will be dependent on how well the board members get along and make the right decisions for the business. So if there is that conflict in the business or conflict among the board members, effective corporate governance will not be achieved. Now, another bit in terms of dysfunctionality is the board is still, things coast along, but nothing new ever happens. So the board members are not innovative. They are not coming up with or looking out for new things which would, help build or grow the business, as well as thinking around emerging risk which may lead the business into some level of exposure, and how they are proactively anticipating these risks to ensure that they are mitigated to reduce the level of exposure to the business. Another bit is the board works well in calm times, but can't cope with change or crisis. And this is very evident in most boards. If the board doesn't have the right caliber of people on the board is not being proactive and anticipating emerging risks. Once that risk or crisis occurs, they are found wanting because they are not really, or they are not completely doing what is expected of a board, being proactive and also ensuring that they have the right caliber and diverse members in place to uphold the responsibilities of the board. And lastly, the board seems to move from crisis to crisis. This arises as a result of poor management. So you realize that every now and then, the business is in some level of crisis, and there's usually no clear-cut roadmap to ensure safety of the business. This gives an insight on whether the board is dysfunctional or not, because if the board is well established with the right caliber of people in place, that level of sound management will be put in place to ensure that the business is thriving as expected. So let's look at the key roles of stakeholders in corporate governance. So when it comes to corporate governance, the center of corporate governance is the board of directors, and there are key stakeholders from an external point of view to an internal point of view. So you have the auditors, the regulators, the auditors, regulators, customers being part of the external stakeholders, and you have the employees, management, and shareholders being part of the internal stakeholders. Now, when it comes to the role of shareholders in corporate governance, the first thing you need to the first thing that the board, the shareholders do is that they select the board members. They ensure that a board has been constituted and have been set up in the right manner, which opposed to the requirements of the legal framework in which they operate in. They also have the right to influence the decisions regarding changes in capital. So when it comes to a business, your fundamental aspect of a business to even start operating is the capital in place to ensure that the business can be set up and run accordingly. Now, the shareholders have the right to influence decisions with regards to the changes in capital, because at the end of the day, it's their money that has been put in the business. So whether they would agree to the dilution of shares or addition of shares, this is something which would have to come from the shareholders, which obviously is based on the direction from the board of directors. Influence and amendment to the regulations of the company. At the end of the day, although the board of directors are the ones that approve the policies and procedures that a company more or less operates with, the shareholders have a role in influencing what is required, because at the end of the day, the ultimate requirement of a business, or the ultimate objective of the business, is to maximize the returns of the shareholder. So if there will be amendments to policies and procedures which would impact the profitability of the business, they can come in and share their thoughts on it and whether these amendments can be done. In terms of approval of extraordinary transactions, this also falls as part of the role of the shareholder, because at the end of the day, whatever returns be made will be subject to their decision in terms of, is it making the right profits for the business? Is it congruent with the aims that they have put in place, or the objectives that the company has put in place? And obviously, the shareholders are more or less the bankrollers of the business. So at the end of the day, you would have to get their take on these extraordinary transactions or decisions which would impact the business. The shareholders are also part of decision making in terms of approval or election of auditors and the approval distribution of profit. They have a say in who they would want the company to be audited by, and also whether there should be some distribution of profits when profits are made. And lastly, decision making on instances that directors have no power over. So, for example, if there's supposed to be a change in a significant aspect of the business, like a company institution, this decision has to be made and approved by the shareholders, just so this change can be done. Now, looking at the board itself in terms of corporate governance, as the board as a key stakeholder in terms of corporate governance, there is this definition from the UK Code of Corporate Governance, which reads, board of directors are responsible for the governance of their companies. The responsibilities of the board include setting the company's strategic aims, providing the leadership to put them into effect, supervising the management of the business, and reporting to shareholders of their stewardship. This is a very long definition. However, it more or less states what is expected of the board. So the board of directors have two roles, from a supervisory role to a stewardship role. Now, from the supervisory role, they are looking at holding management to account, ensuring that from a tactical and operational point of view, the business is running as is expected. They provide challenge to the management of the business, ensuring that management are challenging enough and not left comfortable with the deliverables expected of them. They also monitor compliance. At the end of the day, if you're in a regulated environment, there should be some level of compliance expected from your end. So the board drives that level of monitoring of the compliance element when you're in a regulated environment. Also, they seek assurance that the strategy that they have set and the performance expected are on track. As I mentioned earlier, the board sets the strategy of the business by making decisions which will ensure that the company is operating as effectively as it should be and is aligned to the vision and mission of the business, and also the objectives of the business as well. So once these things have been set or put in place by the board, they more or less seek assurance that these strategies are on track and they are performing accordingly. Now, when it comes to the stewardship role, the board is supposed to guide and shape the business. This is through setting up of or approving of policies and procedures that will guide the activities of the business, help setting strategy, which is a core thing for the business, for the board of directors, establish the company culture, values, and ethics, which helps in the code of conduct from the board point of view, as well as to the lowest level of employment. And also, they are supposed to determine performance targets. So once a strategy has been set, there should be KPIs put in place to measure the extent of performance with regards to the strategies set. And when proper critical success factors have been put in place, you would be able to know whether you are achieving your target or not. So when it comes to the fiduciary responsibility of directors, there are three key things that you need to look at. The first one is the duty of care. This is where the board members carry out their responsibilities in good faith, keyword being good faith, and using the level of, using the highest degree of diligence, care, and skill, which ordinarily prudent person would reasonably exercise under similar circumstances. So when you are a board of directors, it is your fiduciary responsibility to ensure that you are acting and seen to be acting in the interest of the company and working according to good faith, carrying your responsibilities in good faith to ensure that what is expected of you as a board member is delivered. There should be some level of, or there should be duty of loyalty. That's the second one. And it requires officers and board members to act in good faith in a manner that is reasonably believed to be in interest of the group or public purposes, rather than their own interests or the interests of other organizations. So if you're a board member, you should have the highest level of loyalty to the business, which comes first. So any decision that you will make should be consistent with the requirement of the business or expectation of the business. And lastly, duty of compliance. This is the duty of the board of members to ensure that the group or the company is operating in line with its stated purposes. So that is basically the 3 fiduciary responsibilities of a board member. Now, when it comes to committees of the board, this list you see here is not exhaustive. This is just more or less giving you insight of the various committees that you see in the board or subcommittees that you see in the board. And these subcommittees help to make faster decisions than rather have it made in the board collectively, because once you have a bigger quorum in terms of decision making, there may be a difference of views, and also the level of experience or expertise may not be adequate. Not everybody would have the sound or adequate knowledge of the decision which is supposed to be made. So it's best to more or less break down your board into subcommittees who would have specialized experience in making certain decisions. So, for example, let's take the audit committee. They are responsible for overseeing the organization's financial reporting and internal controls, as well as hiring and managing the head of internal audit and the external auditors. So they see to it that the financial reporting and internal controls of the business are robust internal controls have been put in place, which feeds into the financial reporting of the business. And they also ensure that they have sound and qualified head of internal auditors and reputable external auditors to check whether the opinion of the business is stated truly and fairly as expected. So you can also have a governance committee, which is responsible that the board in itself is operating effectively. They look at setting up the organization's policies, bylaws, etc. There's also the compensation committees. In some jurisdictions, they call it a remuneration committee, which is responsible for determining the packages of executives, including their salaries, bonus, equity awards, etc. You also have the finance committees. A finance committee basically looks at reviewing and approving the company's budget, financial statement, and investment strategy. So in this manner, in this instance, when you look at finance committees, they are looking at anything related to financing of the business, from how you plan in making your plan, that is making the budget, how it is reported in terms of the financial statement, and how you are turning around your money or your funding in terms of your investment strategy to ensure that, although you are making profits from the day-to-day operations of the business, what are you investing in the long term to ensure that the business is a going concern and the profits expected in the medium to long term are coming in as expected. The nomination committee looks at, recommending or identifying the potential candidates for board membership, and also is expected to help in evaluating the current board members to ensure that the board members are acting and working effectively as expected. And last but not the least, we have the risk committee. They are responsible for the risk management of the business, from identifying and assessing potential risk, either remote or emerging, or even a significant risk which would impact the business, and also identify or determine which mitigating controls can be put in place to ensure that the strategies of the business are met. And lastly, the ethics and compliance committee, they are responsible for the conduct of the business in terms of whether the company is operating ethically and is compliant with the laws and regulations in which the organization finds itself in. So these subcommittees are not extensive. These are the main ones that you see in most boards. Not all boards, depending on the size of the board, some of them may be merged or put together. Some of them too, for example, the audit and finance committee can be put together as a board. The risk can be a standalone. Governance and compensation can be put together as well. So depending on the size of the maturity of the business and the board, these subcommittees can be merged or, can be operating independently of each other. So when it comes to the board dynamics, in terms of board members and their expected behavior. It's expected that, the board of directors or board members are to behave in an open and honest manner. They are supposed to value individual contributions and not take challenge personally. So during board meetings, the main objective of the board is to make decisions, and this should be on a strategic level. So if there is a conflict in, perception or concepts being brought on by individual board members, this should be challenged, and to ensure that this has been well thought through. And if these challenges come in, it shouldn't be seen as an attack, but to ensure that you have put together a robust thought process which would ensure the success of the business. Board members are also supposed to be disciplined and focus on matters at hand. As I mentioned earlier, in terms of the functional boards, if proper decisions are not made and at the end of the day, the board is not acting as a collective and being responsible, this is not seen as good behavior of a board. So at the end of the day, the board members have to be disciplined, ensure that they have to focus on what they have been brought to the board to decide on. They should also look at taking collective ownership for the board actions and decisions, even if after the discussion there's still lack of unanimous agreement. So the board usually comes to a resolution when it comes to decision making where board members vote. Once there is a majority, that means that is the decision of the board. Yes, it will be documented in the minute the extent of your acceptance of the decision. However, once the decision is made, there should be a collective effort to ensure that that decision is seen through and implemented as expected. In terms of other examples, you are not supposed to confuse disagreements with disloyalty. If you disagree with someone or your fellow board member, that doesn't mean you are disloyal to the person. It just means at that point in time, you just don't side with whatever decision that they have made. You are not supposed to criticize other board members outside the meeting. What happens during board meetings should stay in the board meetings and should not be discussed outside, because once these board decisions or discussions are discussed outside of the board, it doesn't show the level of confidentiality as well as collective mindset of the board to be appearing as a collective body. Now, also to seek to place blame with individuals. As I mentioned earlier, once a decision has been made, it should, although even if it's not unanimous, there should be some level of understanding and congruence and ensuring that these decisions made are well implemented. So at the end of the day, if it doesn't work, one person shouldn't be singled out to be blamed, but this is a board decision which was made, and because you are acting collectively, the responsibility should be taken collectively. Now, the last bit is to take up board time unnecessary, and members will respect the board and use time appropriately. So board meetings should be tabled and discussions should be made based on the agenda set during the notices which are sent to the board, and any other matters should not be extensive and drag board meetings, and time should be used consciously. Now, moving on to rules of the board in effective corporate governance. So when it comes to the role of the board for effective governance, corporate governance, board members are supposed to contribute and provide challenge to the strategy and its implementation. I think I mentioned this thing earlier on. So there has to be consistent decision-making and sustainable business model. The board members are also supposed to articulate and maintain a culture of risk awareness and ethical behavior. I think these things are more or less elaboration of the other aspect that I've already mentioned. So there should be that level of that culture of risk awareness in the business and the highest code of conduct in the business. And in this instance, there should be incentives to help ensure that people are doing what is expected, as well as non-executive directors holding management to account of what is expected of them. There should be a high level of articulation of appetite to manage the risk and review the control framework for alignment. So every board sets the risk appetite of the business. The risk appetite being the extent at which the board can accept a certain risk. Now, if that risk appetite has been clearly set, they should be clearly articulated to ensure that those who are managing the risk understand what is expected of them, the threshold of risk which they can take, and also whether there is any buffer to ensure that mitigating controls have been put in place. So in this instance, this helps give active oversight of the risk, and also helps meaningful and targeted management information, which will help in decision-making ultimately. Going on in terms of the effective roles of the board in effective corporate governance, the board oversees the design and operation of firms' remuneration systems. So this should align with incentive to prudent risk-taking. So it's more or less a risk and reward kind of thing, whereby the board would have to set up a proper committee which will look at the extent of rewards or remuneration given to the key management personnel or the highest level of decision making of the business, to ensure that the risk that is being taken is commensurate to the rewards that is the remuneration being given. The next one is board acts in the best interest as well as ensures the safety and soundness of the company. So we've spoken a lot about conflict of interest and also independence, just to ensure that you are acting in the interest of the business and not your individual as a person, whereby you intend to make profit or gain unfair advantage in any situation. Also, the subcommittee support the board adequately challenge information on behalf of the board. So the board has to be accountable and not relieving its responsibilities to, one second, sorry, my screen just dropped off a second. So as I was saying, the board should have subcommittees who challenge the information which is being sent to the board. So if you have subcommittees like the audit committee, they would challenge the finance team in terms of the numbers which are being reported. They would be able to challenge the auditors in terms of the opinions being given with regards to the financial statements. And before it gets to the board, all these relevant questions would have been answered, so that when it gets to the actual board meetings, quick turnarounds can be made in terms of decision making for the business. Now, looking at other roles, such as having sufficient time to discharge their duties with meetings organized with adequate time set aside. When we talk about this, we are looking at the board members' responsibility to be able to ensure that it partakes in the required board meetings required based on the regulations that or the regulated area that they find themselves in. So, for example, from Bank of Ghana point of view, you are supposed to have 4 board meetings, a minimum of 4 board meetings a year, that is quarterly. So as a board member, you should be able to have put in place adequate or sufficient time to play your role as a board member to ensure that the right decision can be made. This will help in genuine and open discussions, and also ensure that relevant support, including training and professional development, have been put in place. So as a board member, you should avail yourself to the relevant trainings and whatnot expected to ensure your continuous professional development, which will help in making sound decisions during board meetings. You're supposed to receive timely and accurate and complete management information to fulfill its obligation as a board member. So this will help reduce or aggregate exposures and see which critical things that need to be looked at and decisions to be made, as well as actively managing information overload. And this would help avoid such instances whereby not irrelevant information is sent to the board. And also it helps in exercising sound judgment. There should also be a part where there should also be a role, a responsibility of the board to develop and maintain relevant succession plan. I think this Nanecha mentioned on it earlier on, and it's consistent in both the regulated aspect from a BOG point of view to the National Corporate Governance Code. And there should be some succession plan put in place to ensure that you are prepared for the unexpected, and also you are recognizing that there will be future needs for the business, and you are anticipating or putting in place measures to fill in that gap. The NEDs are also supposed to hold management to account, and the executives are responsible, ensure that the executives are discharging their responsibilities properly. So the NEDs, being the non-executive directors, are brought in place to ensure that they are, challenging what management has brought on board, and from an independent point of view, ensuring that the management is, discharging its responsibility as expected of them. So for listed companies, half of the board, at least half of the board should be NEDs, and for smaller entities, at least 2 of the board members should be NEDs, and also the chairperson for each board should be independent. So you go into companies whereby the chairman is also the CEO, that is not a good reflection of good corporate governance. So to ensure that you have good corporate governance, the chair should be independent of the business. In terms of executive decision judgment in running the business, the board is also supposed to promote the success of the organization. In this manner, we are talking about having clarity around delegation in terms of the expectations being set, what is expected, and ensuring that there's a clear KPI related to the expectation set, and management are held accountable for achieving such KPIs. NEDs also are expected to hold sufficient current and relevant knowledge and experience. The non-executive directors who are not part of running the business should have relevant information or knowledge as to the business that they are assisting in or being put in stewardship to make decisions. Hence, in the board, there should be some diverse level of experience, clear and transparent information as to what is expected to make the right decision, and also access to expertise. NEDs are supposed to have some level of expertise in whichever board that they will be serving on. It shouldn't be, an experienced level of expertise, but at least the foundations as to what is expected. So for example, if you're a board member of a bank, you should have, or should I say a fintech, you should come in understanding what is expected of an organization who operates in the fintech space, and as well as have the mindset to also increase or improve upon your knowledge base to ensure that you are bringing meaningful insights or making meaningful challenges which will be constructive for decision making. So that is it for the board's role in corporate governance. Let's look at senior management. For senior management, the expectations of senior management is to ensure the day-to-day management of the business, implement the actions that have been set by them based on the strategies set by the board of directors, and ensure that there is compliance with regulatory requirements. So these three are the key, roles of senior management. And for senior management, once these boxes are ticked, or once these expectations are operational, it ensures that there is some level of collectivity or goal congruence in terms of the strategy being set by the board, and this would ultimately lead to sound corporate governance as well as high level of operation of the business. So in terms of the board and how it interacts with senior management, we have a pyramid here which more or less shows the breakdown of expectations. So first of all, we have the board of directors who sets the appetite, the risk appetite of the business, and the expectations from them is a dashboard which shows the information that is expected to make this decision. So in terms of the dashboard, you would have the the board packs being sent to them, indicating the high-level information which will help them make the decisions. Now, cascading it down, remember we mentioned that every organization should, once you have a board, should have subcommittees so that decision-making can be faster. So as and when board meetings are held, the subcommittees would have already discussed relevant things, which would then ultimately feed into the board decision. So from the board of directors, the most significant committee is the audit committee, and what is expected of them to have in place are the charters and also dashboard in terms of the financial reporting bits and the internal controls aspect of the business. Now we have the executive risk committee and management oversight committees. These are more or less the operational side of the business. So looking at the top two, they are at the board level. The next two are the operational side of the business. So this is where you find the CEO, the CFO, and whatnot. In some organizations, these executives sit on the board, so they are also board members. However, this is the expectation of them. They should have the charters in place, policies, and have adequate reporting, which feeds into the audit committee, then ultimately into the board of directors. Now, before these charters and policies and reportings can be done effectively, there should be some level of oversight activities. And these oversight activities are governed or directed by the procedures that have been put in place based on the policies that were ultimately or originally established by the company. And at the end of the day, once these policies are followed through, they should be reported into the executive, which goes up into the audit committee as well as the board of directors. And lastly, we look at the line business risk activity. So these are the basic activity level of the business. So you have the finance department, your sales department, your HR department. Based on the various procedures that they have, they would work according to those procedures and then feed into the management reports, which cascades upwards. So in terms of line of business function, this is where the risk usually originates from, and this is usually looked at from, depending on the lens that you are looking at it from. You can have from the board of directors point of view, cascading down from the strategic point, or the line of business activities, which gives you information in terms of reporting risk to the board. Now, in terms of the role of the board versus the role of management, the board selects, advise, evaluates, compensate, and if necessary, replace the CEO and other senior executives while overseeing succession planning. On the other hand, management responsibility is just to implement corporate policies and performance metrics and also recommend recommendations. They don't approve, they can recommend compensation and develop executive succession plan and build and develop the teams that they work with. The board is also supposed to approve the strategic plan, governing and documentation, and financial plan of the budget. From the management point of view, they are supposed to collaborate all the risk across the business and the strategy groups, develop and propose the strategic plan. So bear in mind that looking at it, the board, the management, just to, cut it short, management gives board insight and the board approves based on the information that they've received, or externally would have some foresight and give direction as to what is expected from the business. So looking at the third one, review and discuss top and emerging risk, as I mentioned, risk profiles and performance relative to strategy and risk appetite. And in this instance, once they review that, management is supposed to monitor and report on this risk profile and the limits that has been set. The board is also supposed to establish organizational structure and policies and challenge management where necessary. I mentioned this earlier on. The board, it cascades from the shareholder in some extraordinary cases, but the board is supposed to, ensure that policies have been put in place, which the operational side of the business will follow. So they will set the values, etc., letting the business or those who work within the business and externally know that this is what is expected of them. This is the values that the company has. These are the objectives. These are the policies that they follow, just to serve as a guide as to how things can be done on a day-to-day manner. So management responsibility on this side is to execute the day-to-day activities and implement the policies which have been set by the board, as well as managing the control architecture of the business. Lastly, the board approves the risk appetite and internal control frameworks, as well as internal or external audit plans, discuss effectiveness of internal frameworks and the organizational regulatory compliance. So as I mentioned earlier, it's a board's, role or responsibility to look at things from the highest level and ensuring that certain aspects are in place to ensure that the day-to-day running of the business is done effectively. So, for example, looking at it from an internal control point of view, from a board's perspective, let me even go back, looking at it from a risk point of view. From the board's perspective, they set the risk appetite and ensure that there's a risk framework that the business would be using in their operations. Subsequently, once this risk framework has been put in place, what are the internal controls being put in place to ensure that these risks are mitigated? So an internal control framework is put in place to ensure that there is a guide as to how these risks identified based on the risk appetite have been established. Now that once this is done, what management does is to review and recommend the risk appetite and internal control framework. So they are the operational side of the business. They know what could go wrong. So they give input to the board to ensure that risk and the controls are monitored adequately and the organization is in compliance to whatever is required, be it from a regulatory point of view or be it from an internal compliance point of view. And this will help remediate the significant control issues which have been identified during the review that the management does. So that is basically it when it comes to the role of the board and management. Lastly, I'll just like us to talk about failed corporate governance and why there was some level of failure. So in the past, looking at the evolution of corporate governance, I think I mentioned why there was some, I mentioned some failures that led to the establishment of corporate governance. So in terms of reasons why corporate governance, reasons why companies fail, and in terms of, looking at it from a corporate governance point of view, first of all, there's a lack of purpose and strategy. The purpose and strategy is misaligned and the business decisions are not made in line with what is expected of the business and the values that the business has. Inadequate supervision and enforcement. So policies and whatnot have been put in place, but they are not carefully and adequately, or should I say regularly monitored and enforced. And in this instance, this led to the exacerbating banking crisis in Ghana in recent time from, I think, was it 2017 or so, whereby if you look at most of the banks that collapsed, it's not that they lacked the policies in place. However, there was no level of consistent monitoring to ensure that decisions being made at the board are followed through. And also, in some instances, the directors fail to make the right decisions, which were supposed to be in the interest of the business. Last but one is weak boards, lack of capacity or incompetent board of directors who are supposed to ensure good corporate governance. So in this instance, when you are setting up a board, and there should be some diversity in the board, and the people that you bring on board should be competent enough and of sound mind to make the right decisions on the board, which will ensure that good corporate governance is, enforced across the business. And lastly, weak corporate culture. The tone on the top was very, very weak. Bad reputation from the board point of view, leading to inappropriate practices internally, because obviously the board are more or less the leaders of the business. So if they are not setting the right path for people to follow, or not even correcting the people at the operational side in doing what is expected of them. It more or less inculcates some weak corporate culture where the right thing is not done, and this will lead to failures due to, reputational aspect, as well as having a substantial impact on the shareholders' value and bringing down the company. So these are basically some reasons why corporate governance failed. And these are examples of, failed corporate governance. So a typical example is the Enron case, whereby, wrong decisions were made at board level. They were not anticipating the risk. They were not challenging information brought by their external auditors. And once, the issues accumulated, it's kind of caused a very significant blow to the business, and the business collapsed. Another typical example is the UTN Capital Bank takeover by BOG. Wrong decisions were made by the board members. They were not acting in the interest of the business and collectively what is expected of them in the regulated environment that they are working in. And they were not protecting their customers. They were not acting in the interest of the business. So Bank of Ghana had to clamp down on them. And this led to the merger of the UT Bank and Capital Bank into what we now know as CBG. And also, there were other aspects in terms of BOG, taking or revoking the license of some of the business banks in Ghana because proper decision making was not done in terms of ensuring that they have the capital, or there's enough capital adequately put in place to ensure that they meet the requirement of the capital adequacy from the BOG. So these are typical examples as to why why organizations failed. From a medium to small scale point of view, there is not enough documented or published information to cite examples, but from the regulated entities, these are a few examples to show why poor corporate governance led to the collapse of certain business. So at this point, I would pause and see if there are any questions. Okay, so I think in terms of the Q&A box, there aren't any questions at this point in time. However, if there are any burning or pressing issues, feel free to drop them and we will gladly respond. Okay, thank you very much. At this point, Fiona, I don't know if you're available. I would like to hand over to you.
Hi, William. Thank you so much, guys, for such an insightful session. I'm sure everyone was busy taking notes and taking all the gems dropped during this session. I think one question that has been, shared over and over is how to keep in touch with your team, and also if the presentation will be shared. So yes, this presentation will be shared. William, would you like to share more insight on how the audience can keep in touch with you and your team? Maybe you can drop your LinkedIn handles in the chat box for them to see and follow and engage you guys on there. How does that sound?
That is fine. So my LinkedIn handle is William Oheniado. As soon as you Google me, you find me there. You can ping me. I would respond as soon as I see it. We can strike a conversation, which I'm sure would be valuable for both of us, because it's a learning process for all of us. Maybe there might be some instances which we have not come across, which will be a learning point for us. And we will also, on the other hand, based on the experience that we have gathered so far, will be able to support whatever agenda that you have. So that is basically it from my end. But the slides that we will share, we would also leave out email contacts. Just in case you want to reach out formally for anything, feel free to send us an email.
Great. I think since there are no further questions, I'd like to say a big thank you on behalf of the audience, the MEST community. We thank you everyone for taking the time to join us today. I know there's probably other things you would have been doing, but we're glad you joined us and we hope that this was valuable to you. Please look forward to the other upcoming sessions. We have 3 more coming up. Follow MEST on all social channels, MEST Africa, to keep abreast with every event that's coming up. Thank you, William and Nana, and have a great evening, guys.